Now we're going to learn how to use discounted cash flow models to make our capital investment decisions. Remember, the first two methods, the payback period and accounting rate of return, did not use discounted models, which means they did not take into account time value of money, but the next two will. The discounted cash flow models take into account the time value of money. There are two methods, the net present value, which we will learn how to calculate, and the internal rate of return, which we're not going to learn how to calculate, but you just need to know what that is. Whenever you're looking at questions that require you to calculate your net present value, you may see the interest rate as being called the discount rate, the required rate of return, or the hurdle rate. All three means the same thing, it's the interest rate. Whenever we're calculating the net present value, the discount rate is what we expect as a minimum rate of return given the riskiness of investment. Given that situation, whenever we calculate the net present value, we want it to be greater than or equal to 0. So our investment is acceptable when the net present value is equal to or greater than 0. Therefore, for net present value, your decision rule whether or not to invest in a capital asset, if NPV is positive, then you would invest in your asset. If NPV is negative, do not invest in your asset. So net present value is positive, you would invest. If your net present value is negative, you would not invest. To calculate your net present value, you calculate your present value of future cash flows and subtract your investment. Let's take a look at an example. Pause the video and take a minute to read this. They want you to calculate the net present value, assuming a 14% required rate of return. You know that net present value is present value of future cash flows minus investment. So you know that you're going to use your present value tables. However, is it going to be your present value of a lump sum or an annuity? We have to read more in the question. It says the company expects the portal to save $60,000 each year for the 6 years. So if it's each year, then it is an annuity. So you know that you're going to be using your present value of an annuity table. You're going to look up 14% for 6 years, and that will give you a factor of 3.889. Now, how do you calculate your present value of future cash flows? You multiply that 3.889 by your principal, which is 60,000, giving you 233,340. Remember, that's only one part of your net present value calculation. You have to subtract your investment, which is $240,000. That gives you your net present value of $6,660. It's a negative amount. Since it's a negative amount, our decision would be do not invest in this asset. If you have cash flows every year, but those cash flows are unequal, you cannot use the annuity table because that is not an annuity by definition. You treat each cash inflow as a lump sum, and then you have to discount each cash flow to your present value to calculate your net present value. Let's take a look at an example. They want you to calculate the net present value, assuming a $30,000 residual value and a hurdle rate of 14%. We are going to invest $200,000 now, and these are the cash inflows that we expect over the next 6 years. The 6th year, $30,000 is our residual value. Now what we need to do is to bring all these payments down to our present value so that we can compare it against our amount invested and calculate our net present value. Each of these amounts will be treated as a lump sum. So if you are trying to figure out what your present value of year one's cash flow, you are going to look at an interest rate of 14% in your lump sum table, present value table, and you're going to look at 1 being the period, and then you would multiply whatever factor you get by 100,000 to bring that 100,000 to present value. And then you would do the same for every single year. So you would have multiple hurdle rates. These are the hurdle rates if you look up for each year, 1, 2, 3, 4, 5, 6, using a 14% interest rate. Once you get the factor, what you do is you multiply it by each year's cash inflow. This is the discounted amount, and then when you add it all up together, you get your total present value of net cash inflows. Remember, that's only part of the calculation. You have to subtract your investment of $200,000. That gives you a net present value of $52,200. It is a positive amount, so you would go ahead and invest in the project. Whenever you have multiple projects that pass the net present value test, you can use a profitability index to compare projects of different sizes. This is something that we use for our capital rationing decisions. We talked about that earlier during the chapter, where companies have limited resources, so they need to figure out which projects to invest in. Whenever you calculate the profitability index, it gives you a number. The higher the better. So whatever the number that has the highest profitability index is probably the project that you should go for. The profitability index is calculated by dividing your present value of net cash inflows by your investment. You would calculate a profitability index for all the items that pass the net present value test and look for the one that has the highest profitability index. The fourth and final method of capital budgeting analysis is the internal rate of return. This is the rate of return a company can expect to earn whenever they invest in a project. It is also the rate of return that will cause the present value to be equal to zero. It's the rate of return that will cause the net present value to be equal to zero. And that's pretty much all you need to know about internal rate of return. We will not talk too much more about this, or you don't need to know how to calculate this. Your decision rule whether to or not to invest in the asset is, does the internal rate of return exceed the required rate of return? If so, you would invest it. If the internal rate of return is less than the required rate of return, then you would not invest in the asset. Finally, we're going to talk about the pros and cons of each method that we discussed. First, we're going to look at the payback period. The biggest advantage of the payback period that it's simple. It's very easy to calculate. It highlights any risks. However, the disadvantage of it is that it ignores cash flows after the payback period, and it does not take into account time value of money. The second method was the accounting rate of return. Remember, this is the only method that uses accounting income as opposed to cash flow. So this is the method that uses accrual accounting. The advantage of this method is that this is the only method that shows how the investment will affect our operating income. It also measures profitability of the asset over its entire useful life. However, the disadvantage of this method is also that it ignores time value of money. The third method was the net present value method. The advantages of this method is that it incorporates time value of money and net cash flows. It indicates if an asset will earn a minimum rate of return, and it also shows any excess or deficiency of present value of cash inflows over cost. It gives us how much is it over or under as compared to our cost. The disadvantage of this method is that it's hard to compare different investments of different sizes. However, we can use the profitability index for making capital rationing decisions. That brings us to the end of chapter 12 and all the material that you will cover for this class in the semester. Be sure to bring your net present value tables